Definitely, let's get started. This is the largest group of companies we've ever had at MIF, the largest attendee sign-up that we've ever had at MIF. We actually were commenting that we certainly hope everybody who signed up to come doesn't actually show up because we can't fit you all. That's part of how you organize these conferences, but still, it's always a bit of a balance, and it's tight this time because the markets are exciting. So, I feel like everyone here is probably, I'm making assumptions, but is probably thinking similarly, that gold is looking fairly good. I have been speaking to that for a while now. When I look back, I think we were all pretty excited at the beginning of 2019. We thought 2019 had the potential to be a pretty good year for gold. It started that way with a nice seasonal move at the beginning of the year, and then it was a bit sideways. And it didn't feel as exciting as we wanted it to. A few key things changed there. Interest rates are a big part of what changed during 2019. And also it just takes some time for a gold bull market, this phase, this last sort of third and most exciting phase of a gold bull market to build up its momentum. So I think that's really what 2019 was about, and it's positioned us such that 2020 looks pretty fantastic. That said, we look back at 2019, gold actually gained 18%. That's a big number. And the S&P TSX Gold Index was up 49%, which outside of that surge that we had in 2016 is the best performance since the early 90s. So that's pretty standout on its own. And I pay attention to those numbers because when I was doing my portfolio reviews for my newsletters at the beginning of this year, I looked back and like my low risk portfolio, which is producers and royalty companies and a few takeout targets, it was up on average 40%. And none of that was because a particular company shot to the roof. That's not what happens when you invest in Sandstorm or Kinross. They just slowly march up as the gold price goes. So it's really interesting looking back and seeing that there was excitement in 2019. Investors were showing up in 2019, and now 2020, I think, is going to layer excitement on top of that build. Of course, part of the reason for the excitement, part of the attraction for all of those new investors, is the amount of M&A that we saw in the space. I mean, we had almost $24 billion in M&A in the gold sector, obviously headlined by two major deals, but those are big numbers. And it's all happening for very fundamental reasons. And so I'm going to go through those to some extent. But what I want to put as context is that patterns are called that for a reason. When we look back at gold bull markets, the patterns are reliable. They repeat. Obviously, they have slightly different shapes. But in general, in the last 5 mining bull markets, the TSX Venture Index, which is the best proxy we have for junior stocks in our space, gained 189% over 51 months. Right now we're at 8% over 46 months. So we got a little ways to go. Like I said, the majors have already made a lot more move than that. I'm talking about the junior side of the space, which is what a lot of us are more interested in. And so the takeaway there is the excitement, assuming this market acts like the last 5 markets have acted, the excitement is just around the corner. Clearly, like I said, the big change that happened in 2019 that has set 2020 up for success in the gold space differently than we've had for years is that we went to a negative real rate environment in most of the world, in most of the parts of the world that influence the gold price. Gold is good at gaining. If you go back over the last 50 years, it gains on average 4.5% a year adjusted for inflation. If that were just a steady march up, the space wouldn't actually be that interesting. It would be like a reliable thing that you have in your portfolio. But it isn't a reliable march up. Instead, what happens is gold actually is flat to down. It is sideways or it loses ground when real rates are positive, and especially when they're high. And then it makes up for that, more than makes up for that, when real rates are negative. And of course, and that's what this chart shows, and that's what the gold price chart tries to indicate. And the important part of that story is that rate help from that, what I've been describing, is here to stay. Gold gains when real rates are negative, it slides when they're positive and high. Because countries want weak currencies to gain an edge in trade that's weakening, because central banks around the world are cutting rates and filling the market with liquidity, and because debts are so big, I think it's very safe to say that high real rates, which are the things that cause the gold price to go down, are not in the cards. They are not anything that we're looking forward to. And instead, at least low, if not negative, real rates are our new reality for the next little while. I don't know how long. I can't look that far into the future. But until there's some sort of significant reset of the global system, we have low to negative real rates, and that means gold will go up. The other chart that I had there just shows that the US Federal Reserve is being very exciting in its dot plots and saying it will do nothing with interest rates next year. So if we have any inflation, rates will go more negative. If not, they will just stay right where they are, which is like nothing to negative. Okay, so then the other headwind that gold has experienced for the last few years, for many years actually, is the stock market. Obviously, the stock market has been attracting most investment capital, and as it should. The S&P 500 gained 31.5% last year, which is a crazy number. But at the same time, there was a lot of safe haven action going on. Investors moved $170 billion out of equity and over $500 billion into money market funds. Those kinds of flows are pretty reliable indicators that a crash or a correction is coming. So what's going to happen with US stocks, or more broadly, US growth? I mean, if you want to try and keep things simple, which is my supposed job, there's two options. Either it is or it isn't, right? So either growth is real, or central bank support, which we're seeing oodles of around the world. The European Central Bank, the Japanese Central Bank, the Federal Reserve are all pumping money into the system. The reason they're doing that is to inflate financial assets and try and keep the bubble going. So either we have real growth, which is possible. It's been sluggish, chomping along, whatever. So either that continues and or central bank support keeps the bull market alive, in which case we have some confidence, we get some inflation, that pushes real rates more negative, and in that context, we get to have fun with both gold and copper. Or growth doesn't work, and or central banks fail in their quest to inflate financial assets. Stocks falter, confidence is shaken, and investors look for security, in which case we don't get to have fun with copper, but we do get to have a lot of fun with gold, even more fun than we would in the first scenario. So gold is set up in either situation, and the base metal argument is there. Now I'm going to return to copper just at the end for another comment, but let me leave that there because I'm trying to focus on gold right now. Which of those two paths are we going to take? I have zero clue. Every day I see completely mixed data. Like these two charts came in almost back-to-back emails in my inbox. One of them clearly shows that global manufacturing is strengthening, and the other one clearly shows that global manufacturing is weakening. So I don't know. That's like two emails of the hundreds that I get that have economic data that come at me. It's all totally mixed. We all are going to have our opinions. I certainly think that corrections in the stock market are certainty. Crashes, I don't know. The thing is, though, the fact that none of us know means that uncertainty is the force that's causing all of those money market flows, that's causing money to come out of equities despite the S&P having gained 30%. So the safe haven trade is to buy bonds because bonds provide yield and give countercyclical performance, except that the bond market is a mess. And I've talked about this the last few times I've been up here. It's still a really important theme, which is why I'm talking about it again. We have almost $20 trillion worth of bonds that carry negative yields. That means the big pools of money that have always invested in bonds for that safe trade can't get the yield out of them that they've always gone there for. That is a mess. And so you need to have an alternative safe haven investment. And gold is one of the only things that works. And that's why I love this chart. I think it's one of the best correlations out there, which is the global value, or the market value of global negative yielding bonds and the price of gold. The more negative yielding bonds there are, the higher the price of gold goes, because all those big pools of money that would usually buy bonds for safety have to buy something else to sleep at night. Okay, the other headwind for gold is the US dollar, right? We price it primarily in the US dollar. That's the price that a lot of people pay attention to. Strength in the US dollar pushes back against gold. There is good reason to think that the US dollar strength that we've experienced in the last decade, well, not quite decade, 5 years, will change. And I know that Eric does a much better job going through this argument. It is from him primarily that I understand this setup. He's the economist. But at the end of the day, we all know that the US relies on debt. It has for a long time. But what has shifted is that the US is now having trouble because of low or negative yielding, because of such a low interest rate environment and an abundance of debt issuances. It is having trouble finding buyers for all of its debt. That means US primary market dealers are left holding the bag. That's why we're getting these repo market operations that we're reading about, $60 billion that is being injected in the repo markets. What's happening there is the Fed is printing money to buy treasuries from the primary market dealers who have to buy them. That's their job. The bottom line is the US is monetizing its debt, its deficit, because of a lack of buyers. There's only a few ways to get out of that downward spiral. You can either seriously cut spending. What are the odds of that? You can boost interest rates significantly. Not an option given debts, corporate and government, not an option, and sluggish growth. Or you can have a weaker currency. Those are the three ways out. So US dollar weakening is the answer. So I think there's good reason to believe that this shift is already underway and will help gold rather than the dollar hindering gold as it has in recent years. One thing that I talked about in my last newsletter is that, yes, 2019, like I say, investors certainly started showing up. That's why gold majors performed quite well. But one of the really interesting aspects, I think, of a gold market is that gold momentum builds on itself so in such a obvious manner. And it's partly that gold is considered sort of an odd sector, and so people don't, especially high-profile investors, don't talk about gold unless they're really sure, because they don't want to be called a gold bug. It's like the worst slam you can give an investment leader. So they wait until they're really sure. But now they're like all talking about gold as the trade of the year for 2020. This is just a list of names that I've seen recently that have pegged gold as being the trade of 2020, and you'll note that they come from across the investment spectrum. Hedge Fund Guide, Macro Trader, Bond King, Emerging Markets, Real Estate, Jim Cramer. I get a newsletter from a guy who writes about bonds, and he's instead talking about gold. So this kind of talk really helps gold momentum build. That really matters. This chart is a bit dated, but regardless of the fact that the right side of the chart isn't up to date, what matters is the middle of the chart there that shows how much amplitude we get out of gold stocks when the bull market really goes. There's still a huge amount of room to run there because, as I've just outlined, these macro forces that are propelling gold are not going away, and investor interest in gold equities is building. It's really building now, and that generalist rotation, I've harped on about this since the gold market began in 2016, but now it's actually happening, and it really matters. It is what creates the bull market that we're all so excited about. Okay, so I talked a bit about copper before. I do want to return to that topic for a moment, partly because I've been seeing articles about the opportunity in copper across the mainstream media, which is really interesting because in the second half of 2019, nobody would talk about copper at all. Even people who loved copper would turn the other way if you asked them. Because of this sentiment issue that we had, right? The trade war was really dominant. Nobody was willing to bet on a growth-based story, which is what copper is, in the face of a massive trade war that had no end in sight. We now have a phase one trade deal. I don't think it does much. I don't think China's going to live up to it. China can't buy as many agricultural goods as it says it's going to. The tariffs are largely still in place. The phase one trade deal is like a tiny drop in an overflowing bucket, most of which hasn't even been talked about at all. But sentiment is an interesting thing. Sentiment likes simplicity. The trade war is very complicated, so sentiment has tried to distill it down. Right now, sentiment is, okay, we're making progress on the trade war. We can talk a little bit. We can think a little bit about growth again. And In that context, we have a copper sector where the fundamentals are incredibly strong now. Copper inventories are down to 5 days of global consumption. That's a low, low number. Mine production is falling. There's a lot of threats to some of the major mines that are out there in terms of production this year. The new project pipeline is pretty darn limited after a bunch of weak years. Banks across the board are bullish. They're encouraging investors to move in. So I think fundamentals might matter for copper this year, which I'm very heartened to say, because it's always tough as someone who analyzes these sectors to see strong fundamentals like, hardly any inventory, demand growing, production barely meeting demand, or a gap coming, and not see the price perform because of sentiment, this ephemeral thing. But I think this year fundamentals might matter for copper, and I think what we all should do is watch some key copper stocks over the next month or two, whether it's, copper leverage plays, ones that have big reserves of copper miners, see if they do start to move. And that will be sort of the bellwether of whether there's all this talk about copper, if people are actually acting on it. Just as a last slide, I only have so much time when I'm up here, so I focus on gold because gold sets the stage for everything else. At least at this juncture, I think gold sets the stage. That doesn't mean it is the only thing that I care about. I certainly also like silver. The metal price follows gold and then shoots past it. That's just arithmetic because it's a percentage-wise. It's starting from a much lower price. And then on the equities space, there are far fewer silver options out there, silver stocks, silver-focused stocks. So when interest does turn to silver, those stocks outperform gold stocks in a precious metals market. So definitely make sure you're paying attention to silver. And then palladium has been absolutely killing it for the last 2 years. Is the price going to continue to rocket higher? Some people certainly think so. What I think matters here is that we're in a new pricing paradigm for palladium. So the price of palladium is not going to come back down to $700. The price of palladium is going to settle somewhere much higher than that, like a double of what it used to be. That means that PGM projects have to be looked at completely new again, right? Because we have a new pricing paradigm for palladium. And so that just creates some interesting opportunity in the PGM space because projects that didn't make sense before can make sense now. And more so, we just need a bunch of palladium. And so interest is coming back into the space. Good projects are being reactivated. We have 2 of them here today. And so, yeah, I think it's important to pay attention to palladium for those reasons. That's all I'm going to say for now. These are the letters that I publish. I publish a weekly newsletter that's about what I'm buying, selling, and thinking in the metals and mining space. It's sort of the medium to high risk stocks, the majority of my portfolio. I also publish a monthly newsletter that is designed more for someone who's newer to the space and wants lower risk ideas and higher level information about opportunity in the metals and mining space. I have a premium service for those who are interested in participating in the private placements in which I participate. And like all the other newsletter writers who participate in this conference with me, none of us accept money from companies, which is fundamental. So thank you so much for your attention. And without further ado, I am going to ask